PayPal is a company I own in my personal portfolio, and currently it makes up about 7% of that said portfolio. I did buy it at $66.50 a share. It is currently trading at about $71.50 a share, but I do believe that there is still time to buy this company quite cheap. Now, to figure this out, we will, as always, jump to my stock valuation spreadsheets, where we will go through 4 of our valuation models as well as the 9-pillar analysis to, well, figure out if the company is undervalued. So jumping to the first valuation model, the Graham's formula, we will figure out their intrinsic value based on their future earnings per share growth estimate. Now, to figure this out, we can look at the net income growth. And as you can see, from 2020 to 2024, the net income has actually decreased by 1.31%. Looking at the earnings per share, that has increased through the past 5 years by only about 13%. And of course, the reason for the earnings per share increasing despite the net income decreasing is the company buying back quite a bit of shares through the past 5 years, 12.47% to be exact. So despite PayPal's net income not growing, they did increase their value by buying back shares. Now, something I do want to point out further is that when we have a look at the cash flow statement, you can see that the net income through the past 10 years has actually grown by quite a lot. From 2015, when the net income was sitting at only 1.22 billion, to 4.14 billion in 2024, growing at a CAGR of about 12.5%. We can further look at the analysts' estimates, and as you can see, into the next 5 years, the analysts do predict a growth of about 10% every single year. In other words, an EPS CAGR into the future of about 10%. So jumping back to the Graham's formula, I think it is quite fair if we predict the high growth at 10%, medium growth at 9%, and low EPS growth at 8%, and this will give us an average growth rate of 9% into the next few years. And after plugging in all these values into the Graham's formula, we will get an intrinsic value of $72.16, which is about 1% higher than the current trading price. Now, moving to the second valuation model, the discounted cash flow model, we will calculate the intrinsic value of PayPal based on their future free cash flow. Now, as you can see, through the past 5 years, the company's free cash flow has been growing at a CAGR of about 9.69%. Now, as I do want to be a little conservative, I will plug in the high growth at 10%, medium growth at 8%, and low growth at 5%, and this will give us a future free cash flow CAGR of 7.7%. Based on this predicted percentage, we will calculate the future free cash flow and then discount it at a rate similar to the WACC of the company. As you can see, our discount rate is currently sitting at about 8%, while the WACC is sitting at about 9%. So we do have to move our discount rate about a percentage point higher. So I will plug in the high year-over-year return, desired return at 10%, medium at 9%, and low at 8%, and this will give us a discount rate very close to the WACC of the company. And so as you can see, after we sum up all the present value of the future free cash flow, add cash and cash equivalents, and subtract total debt, we will get an equity value, which we will divide by the shares outstanding and get an intrinsic value of $111.79. Now, something I do want to show you is how to very simply understand if a company is undervalued compared to their future free cash flow. Say that PayPal was to not grow their free cash flow at all into the future. And of course, inflation would still be a factor, so their free cash flow would actually be decreasing. The value of their free cash flow would be decreasing. So if we plug in the high growth at 0%, medium growth at 0%, and low growth at 0%, as you can see, PayPal's intrinsic value would still come out very close to their current trading price. It is very, very highly probable that the company's free cash flow will grow into the future. But if it didn't, you can see that if you invested into the company right now, you wouldn't be too far off their intrinsic value. Now, jumping to the third valuation model, the multiples valuation, where we will compare PayPal to 2 of its competitors. We will take these competitors' current stock prices and divide by their earnings per share to get their PE ratios, which will then average out and multiply by the current EPS of PayPal to get an intrinsic value of $141.07, which shows that PayPal is undervalued compared to its competitors, as investors would be paying more money for a single dollar of the earnings of Fiserv and Block than they would be for the earnings of PayPal. Now, normally we would go through the dividend discount model, but PayPal currently doesn't pay out any dividends. So before moving to our ultimate valuation, let's check out a few more pillars. One thing I do want to point out is the P ratio of PayPal. You can see that through most of the past 5 years, the PE was sitting above 20, but in 2024 it fell below, and currently it is sitting the lowest it has been through the past 5 years at only 16. That is the same case with the price to free cash flow, which is sitting even lower at only 12.22, the lowest over the past 5 years, which of course means that PayPal is currently trading extremely cheap compared to what they have been trading in the past. I also want to point out that the company's revenue is growing. So despite their net income stagnating a bit, their revenue has been growing at a CAGR of 8.40% through the past 5 years, which shows that the business is rolling forward. And finally, moving to pillar 9, the long-term liabilities. As you can see, PayPal has been increasing their debt at a rate of about 4.5% through the past 5 years, and currently their long-term liabilities are sitting at $12.81 billion, which actually isn't that high. As you can see, the long-term liabilities over the 5-year free cash flow negative dividends ratio is sitting at only 0.45, which means that PayPal would be able to pay off all their long-term liabilities in about 2 years with the free cash flow they are currently generating. As you can see, in 2024, they generated about $6.7 billion in free cash flow, which is about half of all of the long-term liabilities they currently have. And as they don't pay out any dividends, it will be very easy for them to pay all these off while pushing a lot of free cash flow into innovation and staying relevant in the payments industry sector. But now that we have gone through the fundamentals and they are looking healthy, we can finally get to calculating the company's ultimate intrinsic value. So averaging out the Graham's formula discounting cash flow model and the multiples valuation model, we'll get an intrinsic value of $108.34, which is about 50% higher than the current trading price of the company. And so with a margin of safety of 10%, we would get an acceptable buy price at $97.51, which is well above the company's current trading price, meaning that PayPal is still a buy at $71.48. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.